Hello everybody and welcome to today's video. So today I want to talk about Affirm, Upstart, Zoom, Peloton and Opendoor. These are stocks that at any point in time have lost more than 90%. And the question of this video is, will they bounce back? Will they bounce back? Because a lot of us are invested in these stocks and some of us may be upset about what's going on. So I want to give a little background about what's going on in the market and answer the question, will they bounce back? So can you spot, and I put this chart for a reason, this is when stocks started dropping. And the question is, if you follow all of these stocks, can you spot which one is Zoom? Can you spot which one is Affirm, Upstart, Opendoor, or Peloton? And the point that I'm trying to make here is that the market is selling these companies indiscriminately. It's just selling them all, and it's not doing any research on these stocks. It's just the stroke of a pen, just crossing them out, selling them all. And actually, if you are curious which stock that is, these are the stocks: Zoom, Peloton, Affirm, Open, Upstart. These stocks have nothing to do with each other, absolutely nothing to do. Yet the market punished them almost as quickly as it rewarded them. And it punished them way more because so many of these stocks actually ended up trading way below IPO, way below the potentials that VC saw in these companies and even early investors saw in these companies. So why would the market sell these very different works all at once? Why would the market do that? Well, that's because these stocks are not in broad-based indices. They are new stocks, right? You gotta wait 4 years of profitability, say, to be in the S&P 500. Most indices have criteria. New stocks are not going to be in there. And so there is no wall of buyers coming in every month for these stocks, right? Hedge funds do not have to buy these stocks. Algos do not have to buy these stocks. It's not like a stock trading in the S&P 500. So these stocks, they sell at their own, they can be sold at the own discretion of algos and hedge funds. There is no mandatory index weighting like any company would be part of an index. So I think this is a key reason for the correlation. And another key reason, so the correlation is described by this, I believe. The other one is the direction. What is the direction? Why have these stocks gone down? Is it related to business performance? Well, maybe a little bit, but not exactly. I would argue that the market, because stocks are valued about, a discounted cash flow analysis, it's all about the final value, the terminal value, right? The terminal value of these stocks did not necessarily change, but right now, the market has changed. And why has the market changed? Because the market was very long-term horizon before. Interest rates were very low. So they were looking at opportunities. And now the market is ultra short-term. And so hedge funds sold whatever they could sell, i.e. stocks that are not in indices, to focus on the short term, i.e. buy government bonds because they're risk-free. Ha ha ha, that's very funny. Are they risk-free? I made a whole video about Elon Musk chuckling at whether bonds are risk-free or not. So they buy risk-free bonds, government bonds. They buy oil stocks, right? Because oil is a commodity and it's getting cash out of the ground, and oil stock is up right now. Oil is up because of geopolitics. And what pushed them to do this shift, to have this shift so quickly, is this. This is why they reacted so quickly, because the interest rates rose the fastest in the history of interest rates, really, but really the fastest ever in recent memory. I put here, this was the interest rate rise from 2015. So you can see 2015 was actually not much of a rise, right? And so when you rise rates this low, the market has time to adjust expectations. Companies have time to adjust. When you rise rates so fast, then hedge funds change everything right away. They change the way they operate right away. And this is what they did, and this is why these stocks have been entirely crushed. To talk about the dysfunction of the market even more, this is an idea. A lot of commentators are quick to say that there was irrational exuberance on the upside, and I would be more one to say that this is an example of irrational exuberance, which is Tootsie Roll I couldn't believe this. Prior to Halloween, right? Going into Halloween, 2 months going into Halloween, you had articles like this. Tootsie Roll. I'm expecting a good Halloween. So you got to buy Tootsie Roll, right? Candies, because they're going to sell a lot of candies within 6 weeks. To me, that's irrational. To me, that's dumb. That's dumb. That's irrational short-termism. And I actually made a whole video where I heavily complained about it because I saw Meta trading at a PE of 9. By the way, a week after this video, Meta traded down to a PE of 7. And Meta's trading at a PE of 9 to 7 was trading at that because they were investing heavily in the future. And then you had Tootsie Roll, who was going to have a good Halloween, who was trading at a PE of 39 because they were going to have a good Halloween. This was an example of the market being extremely short-term, like beyond any reason being short-term. So buying Tootsie Roll because they're going to sell a lot of candy for Halloween is an example of irrational Mr. Market behavior, and you should realize that the pendulum has swung the other way. Like, even if I were to accept that there were some excesses in 2021, which for a lot of stocks I don't agree with that statement, but even if I were to accept that, now we've gone in an era where the excesses are all the way on the other side of the pendulum, where it's all about next quarter, and that is sad. That is unfortunate for a lot of these companies, but it is just the way it is. So there is a chance that Upstart, Affirm, Zoom, Peloton, or Opendoor can go bankrupt. There's a chance, but frankly, these bankruptcies would be mostly driven by the macro. That's what I believe can happen, because these businesses were at least sound enough to some of the smartest VCs out there. And they were sound enough to investors who, when they bought at the IPO, did their due diligence. I believe especially retail investors do good due diligence compared to what a lot of people are thinking. A lot of people would say it's hedge funds who do due diligence. I bet you about a bunch of hedge funds bought Tootsie Roll because of Halloween is coming up. No, I believe retail investors oftentimes do a great job. The wisdom of the crowd. That's what it's all about. So anyways, frankly, these bankruptcies, if there's any bankruptcies involved, it will be macro-driven, and it will be based on the fact that the rates were risen the fastest in the history of interest rates. But what could happen? Why could they go bankrupt? Well, Upstart, and I believe Upstart is the most concerning business on that list. Upstart's collateral on car loans may lead to people that are underwater to walk away from the loans. So essentially, you have people who owe more on their cars than their cars are worth, because the car market is crashing right now. And these cars may go into repossession, and we'll see that Upstart is carrying a lot of debt on its balance sheet, which it did not securitize. So I'm a little worried about Upstart. But what else could happen, right? Affirm customers could stop paying their buy now, pay later loans due to Fed-induced layoffs. But we saw the job report last Friday. It's really, really good. So I'm not too worried about that. Peloton, right? Peloton could sell fewer bikes, for example, due to heightened interest rates on loans that are typically used to buy these bikes or treadmills or rowing machines. But Peloton is mostly a subscription business. Therefore, I'm not as worried about that. Plus, health is very important for people. People are likely to keep paying for their Peloton. Peloton is a loved brand by the people who love those bikes. Okay, Opendoor. So Opendoor could sell fewer homes because the real estate market is not moving. Because mortgages, even though they've gone down, mortgages could go back to 7%. And so nobody wants to buy a house at 7% mortgage, and then on the other hand, right, you have nobody who's willing to walk away from an old house if they have a mortgage at 3%. So you're only left with people selling homes if they're like getting a divorce or getting a job at the other side of the country, which is not enough to make a market. So there could be not enough business for Opendoor to survive. And then I put Zoom. No, Zoom is not going to go bankrupt. No investment advice, but Zoom is not going to go bankrupt. Absolutely not. We'll go quickly into the financials, but the company is a cash machine. And a lot of people say, oh, Zoom, Microsoft will kill XYZ organization. That story is getting old. It's the same story for Amazon. Amazon will kill pharmaceuticals, will kill retail. No, I do not believe Microsoft will kill Zoom. Microsoft offers a minimally viable product for businesses who do not want the premium product. And there will always be customers who want the premium product, right? People use Slack, people use Mac OS, people will use Zoom. We have enough of business history to know that in a market, you have a high-end player and you have an entry-level player. And I believe Microsoft, for things like Teams, that's entry-level. If you've used Teams, you probably know what I mean. So anyways, this is kind of the whole thing. So let me first go through the reasons, the fundamental reasons why these stocks may actually not crash. So let's forget about the short term. We know short term is mostly stories, mostly narratives. Let's focus on the long term. And long term is all about critical thinking. It's all about thinking about these businesses. So qualitative analysis. Affirm. What does Affirm do? Affirm is aiming at the end of credit cards. So one question for you, how do you feel Gen Z, and I could have put millennials and Gen X a lot in there, how do you think they feel about credit cards? Which generation is the future, right? The younger generations are going to replace the older ones. And so Affirm is clearly targeting the younger generation. I think that's a big plus. This is a future-oriented firm. We understand why it dropped so much, but it's headed towards the future. What's another important thing to think about when you think about Affirm? It was founded by Max Levchin. Now, Max Levchin was actually the founder of another firm that you may have heard, which was PayPal. Max Levchin founded PayPal and merged PayPal with Elon Musk's company, X.com. Right? So do we give points to a firm that has a CEO who's part of a PayPal mafia? Have you heard of the PayPal mafia? It was a Fortune article in 2007 that found it interesting that all of the former PayPal leadership ended up founding very, very big companies. Is there a premium? Should there be a premium to a PayPal mafia founder? After all, that management team who went away as soon as eBay bought PayPal, they went on to found some of the world's greatest businesses: LinkedIn, YouTube, right, that we're using right now, Palantir, SpaceX, Tesla, Opendoor, OpenAI. These are all companies that were founded by former top management members of PayPal, i.e. the PayPal mafia. Max Levchin was actually the founder of PayPal. So I think that may deserve a little premium on there. And point number 3, the product that they have, right? The buy now, pay later. I believe it's a 10x better value proposition to Gen Z. You have no debt. You know what you pay, and most often you pay no interest because it is the seller of, clothes who decides to sponsor your interest rates for you. So what does that do? You have much higher repayment rates because the interest rates are picked up by the founder. And oftentimes just low interest rates, a sponsored interest rate, is the end of buy now, pay forever, because what you find is that even though a lot of people pay their revolving credit card balances, even though a lot of people pay them in full, you find that you have a lot of people who don't, and a lot of people for whom credit cards end up being things that you pay off forever. It's done with Affirm. Affirm makes it easy for you to see how you're going to pay. So Affirm, I think, as a 10x better value proposition to Gen Z. But the product itself also has another target, right, which is the stores. And I also believe that it's a 10x better value for stores because some sales just wouldn't have happened if it were not for Affirm, right? You may not have been able to sell a $20 pair of shoes at Forever 21 if you didn't have pay in full free of charge. You might not have sold that $20 piece of clothing. And with technology, they've made a technology where it's easy to make a micro loan or a mini loan, short duration, small amount to anybody anytime they purchase. lastly, and I think Affirm, I will do a full analysis on Affirm because I think Affirm is a fascinating company. Affirm's competitor is really Afterpay plus Cash App. I do not believe credit cards are a competitor to Affirm. At least they are not a credible competitor to Affirm for multiple reasons, to the way Affirm, for example, securitizes the loan, the way Affirm gives an option to customers. But I think what's more important, and I might make a whole video on Affirm because it's a fascinating firm. What's more important for Affirm is that we are pulling off what I call the classic Netflix move against Visa, which is they have an API, but they also have a Affirm card. And so when you go to stores, you can pay with Affirm at any store with the Affirm card. Okay. And if the store does not have the Affirm API, then Affirm ends up paying Visa and ends up paying the fees, right? But when the store has the terminal or the API that works with Affirm, then you're entirely undercutting Visa. So you're using Visa's network of payments to draw in customers, but you're undercutting them whenever you can. This is what Affirm is doing. This is what I call the Netflix move, because that's what Netflix did to HBO. You know, Netflix was amazing between 2013 and 2017, 2018. Why? Because it rented all of these shows to HBO from HBO, right? It rented Big Bang Theory, Friends. It rented all of these shows. And then once HBO realized it had no business anymore because they killed cable, Netflix, then HBO was screwed. So that's a classic move. That's a classic move to use the network of someone who doesn't see it coming. So I think Affirm, the grand picture of Affirm is they could be a parallel payment network in addition to Visa and MasterCard. As we are building that network, which is very, very interesting. I love Affirm. I think it's a very interesting company. And by the way, if you're curious about the PayPal mafia, the CEO, Max Levchin, the CEO of Affirm, you can read about it. It has nothing to do with the mafia, of course. It's just the name of an article in Fortune, but it's very interesting to see and troubling even almost to see so many successful entrepreneurs coming out of one company, one philosophy. So I'm positive on Affirm. Let me move on. Upstart. So Upstart is trying to go after the credit score. Upstart is the end of the credit score. And let me ask you the same question. How do you think Gen Z feels about credit score? Maybe it's a little too cookie cutter, isn't it? Oh, you have applied to more than 2 credit cards on which you got denied. Boom, we denied you for a mortgage. The rules are like too simplistic. They don't take into account the nuance of so many different users. And I think that is what Upstart aims to disrupt. That's why Upstart is disruptive. They want to use AI to approve more people and reduce default odds thanks to the big data that they have on the customers and on their platform. And so that's the back end. And the front end is Upstart offers an API to banks and credit unions to approve loans in minutes as opposed to days. And that's very important for the banks because the banks don't have to have an in-house process. They can just outsource this to Upstart. But it's even more important to point of sales who need to be able to give a response to borrowers right away. Mostly car lots, right? If you go to a car lot, it's very important for you to have a response within, say, 15 minutes. You can do that with Upstart. You can't do that with, say, a local credit union. So Upstart has a very interesting positioning. And I would like Upstart if it were not for the fact that it has started to put some loans on its balance sheet. And that is quite scary. You can see the loans right there. They only had $140 million of loans, right? As they roll them over, right? They issue some of a loan and then they securitize it or resell it to banks. Well, they started carrying a lot of those loans, and keep in mind that those loans are very often secured by car titles, and we know that a lot of car value is dropping really fast. So it's a little bit of an orange flag. We'll talk about Upstart a little more when I go into the financials. All right, let me move on. What about Zoom? So Zoom. I'm laughing. A lot of people are like hating on Zoom, and it went down 90%. But Zoom, I don't think belongs in the category of these businesses. In fact, it's a less innovative business in many ways than a lot of these businesses, but it's much safer. There's no denying that. So what is Zoom? Zoom, their positioning is to be a user-friendly video call platform. It's all about user-friendly. Zoom was started by a small Cisco WebEx team in 2011. They quit Cisco. And CEO, the current CEO of Zoom was the first employee of WebEx, which was a Cisco acquisition. So the first CEO has been working, the current CEO of Zoom has been working in the video call business since 1995. So imagine that. They probably know a lot. Zoom was started after a Cisco exec refused to make WebEx user-friendly. Isn't that interesting? And Cisco WebEx, if you used it, it's still not user-friendly. They refused to make it user-friendly, and so the CEO, current CEO of Zoom, back then a Cisco employee quit with 40 engineers, and they launched Zoom. And I think that's a very, very clever positioning. Not everybody is computer savvy. And one of the bigger questions that you have to ask yourself about Zoom, if you think Zoom's going to go bankrupt, which I don't, but you have to ask yourself, what do you think the future of work is? Is the future of work really, really face-to-face? And again, we've had a knee-jerk back to the 2019 way of operation, because we've gone extreme one way and we're going back the extreme the other way a little bit. The long-term trend remains intact. Firms that get started today, they are going to think about commercial real estate and offices very, very differently. Fewer and fewer people are going to take a plane for meetings. More and more are going to take Zoom calls. Fewer and fewer people are going to use commercial real estate to run their business, and more of them are just going to use Zoom and a whole bunch of other tools to have people work from anywhere. I think that is the future of work, very long term, when you look at the megatrend. And if so, then Zoom is very, very well positioned as the more premium, more user-friendly way to do video call. All right, let's look at Peloton. So Peloton again is totally different business. Like all of these businesses are different. So Peloton is very unique in that it capitalized on not on a technological trend. Peloton capitalized on a cultural trend, which is pretty rare for a lot of businesses that I study on the channel. But I think it's very interesting to study Peloton. So imagine a Venn diagram, and you have a Venn diagram. You have people who hate walking out in public gyms, which is like a lot of people who really, really hate that, especially if you're just getting started. A lot of women, right? They really don't like public gyms. That's why if you go to public gyms, sometimes you have like women only area. Like that's to make, or like Planet Fitness. You have things to make people less intimidated, because a lot of people just are not going to work out in a public gym. That's not happening. But everybody needs to work out. So keep in mind, people still need to work out. They just can't stand doing it in a public gym. Then you have other people who absolutely don't like working out on their own. They go to classes, right? Which is another segment of the gym goer. They hate it on their own. They have to have a class. They have to have a trainer that motivates you. And then you have a third segment, which is people who view working out as a social status. And when you think about popular culture, ask yourself, is working out a social status, right? Scroll down on Instagram, look at influencers, look at big YouTubers, look at gyms like Equinox or Lifetime's Fitness, and you bet that working out is part of someone's self-esteem. It's part of someone status, right? Social status. So when you add these innate needs together, need to work out, need to be social with other people, and the need to have some status, need for belonging, you add all three of those, and you have who Peloton is catering to. So a smaller market than a lot of markets, of course, but for customers who actually share all three, then Peloton is a blue ocean. Like if you are a customer, if you recognize yourself in all of these three of these things, knowing fully that most people are never going to admit that working out is a social status. Most people are never going to admit that. But nonetheless, if you're at work in Zoom calls, sometimes you'll see the exec as a Peloton bike behind on the Zoom call. It's definitely a social status. But most people will never agree. And perhaps because it's subconscious, like there's no way you would agree if it's subconscious. But if one shares all three, then $60 a month for a subscription and $3,000 for a treadmill doesn't sound that stupid if you share all three of those. Because echelon is not status symbol. Anyways, I think I've made my point here. So narrower market, right? Not gonna get the growth that I look for on this channel. So not necessarily an investment that I do, but is it gonna go bankrupt? I don't think so. I don't think so because it has a very clear market. It knows who it is. It knows who it's for. It knows what it is. Then the last one is Opendoor, and Opendoor is a personal favorite of mine. I love Opendoor. I've used Opendoor to sell a house and buy a house. They've saved me money. I was so happy with the service that I actually invested in the stock with that money. Opendoor is a true, addition of 10 times better. Like it's multiple 10 times better features that are stacked on top of each other. It's a pretty complex company to analyze, and I've done a whole series about it. But essentially, what does Opendoor do? It makes selling and buying your next home or your first home much cheaper and much easier and much better. The experience is better. And they do that by doing what? By cutting out the middleman. It's a classic example of blue ocean best cost innovation, right? If you look at Cirque du Soleil, how did Cirque du Soleil end up owning 90% of Las Vegas? They did that type of blue ocean innovation, which is they removed the animals. That was some things people didn't really care about, and that was the costliest part. And then we were able to offer a no-brainer product to the Las Vegas crowd, which is Cirque du Soleil. I'm sorry, it's a tangent, but that explains to you what Opendoor is doing. Opendoor is creating a cheaper, easier, and better product by removing the one thing that very few people care about, which is the agent, the middleman, right? So right now, what that looks like is that a traditional real estate agent takes 3% and 3% per round trip. You sell, it's 3%, you buy, it's 3%, and this is typically all paid by the seller of the house. But nonetheless, there's 3% for each agent. Opendoor takes 2% and 2%. And in some situations, it only takes 1%. And it all depends on your state, your area, what kind of product they have, but they take way less. And of course, when you're talking about, 1% saved, that's 2% saved total. You're talking about that on $500,000, on $1 million. I mean, it's not even funny. Like it's not, you're not 10x better. You're so, I mean, it's not even funny. This is a very disruptive business. This is a very disruptive business. And add that to the fact that because they coordinate buying and selling, you don't need a bridge loan, right? Or a storage unit. You don't need to sell the house first and get a loan, have two loans, then move into the house and then hope you sell the other house. Or you don't need to sell the house first, not get a bridge loan, but get a storage unit, rent an apartment for 3 months and move to a new house. They make it easy to sell. They make selling certain. They remove uncertainty out of selling, right? Whenever you sell a house, you always have that uncertainty. They remove it. They're a liquidity provider. Opendoor just makes the experience much better from all sorts. And a last one that makes it better is that it's a fully digital experience. It's an app. Click on Buy Now. Put your credit card in, that's escrow, and you just reserve the house, and then you do the paperwork. It's really stunning. You don't have to rely on a realtor to book that house or reserve that house to you, and maybe the realtor is in vacation in Cancun for a week or something, and then they're not getting back to you, right? And you lose your dream house. You also have other issues, like you don't have any pushy sales tactics. If you read the book Freakonomics, you know that realtors have a lot of pushy tactics. There's none of that because the app, you deal with an app. You don't have a forced contract of representation whenever you sign a house. If you visit a house with a realtor, they'll typically have their contract ready and ask you to sign it even before you see the house. You don't have any of that with Opendoor because the licensed realtors that show you the houses with Opendoor are hired for $25 an hour. They're called tour assistants, right? And Opendoor just pays them $25 to show houses all day. And for most houses, you just have a lockbox. So it's a fascinating company. I love Opendoor. So we've gone through the qualitative assessment of these companies. Do we see any flaws qualitatively in the long term in these companies? And frankly, I don't think so. I mean, I'm worried about Upstart. We'll see why, because of a mistake that the CEO did. I don't think it's very smart. But I am not worried about these companies. I think they'll bounce back. I think this whole drop was extremely irrational. And unless they are going bankrupt, the value proposition of these businesses to their customer, that value proposition is a powerful one. So they've been validated. These, each of these businesses have thousands of people walking toward a mission. Like the market is so short term right now, but I believe they will bounce back. No investment advice, and they've already started. If you look, as soon as we have a hint that monetary policy is shifting, look at what's happening for all of these businesses. Even Upstart, but I'm less positive about, even Upstart. And then ask yourself, what is the total potential for these businesses over a 10-year period? It's probably huge. You could make the case that if you just have one that succeeds out of all 5 of those, that would most likely repay for the losses from owning any of the other 5. That's an argument that I could make. So let me go on and answer the question of this video. Will they bounce back? A question that I'm asking as, are there any bankruptcy risks? That's the question I'm asking. So bankruptcy risks, are there any? Let's go. So Affirm, over the past 3 quarters, I've averaged it out. They've lost about $100 million a quarter. That's what they've lost. They have $1.8 billion of cash, 1.65 of receivable, and 102 of liabilities, which is what I'm going to entitle here. And the reason why I count receivables, of course, is because they deal with loans. So there's loans that have to be paid in that year. So anyways, that's the only reason I have it here. So I kind of call this a margin of safety cash that they can count on is 1.88 billion. That's 19 quarters. That's almost 5 years. No investment advice, but I think they'll be fine. Almost 5 years will be way out of this madness. Of this short-term interest rate hikes. Will be out of that. So I think they will be fine. Plus, it's interesting, but when you're clear with a customer, when you give a customer a clear idea of when they have to pay, when you remove the rollover option of a revolving credit line from inexperienced customers, when you remove that, you see that the delinquencies are extremely low. And this is, by the way, we're in a recession, right? This is the most recent quarter. So this includes the bad market that we have right now. You still have 90+ day delinquencies only at 0.75%. So that's really nothing. That's much lower than most credit card companies. And that is because they have a clear way of doing it. So I love Affirm. I'll do a separate video on Affirm. All right, now let's talk about Upstart. So Upstart, I said in the beginning of the video, I'm concerned about Upstart. So negative free cash flow Upstart is minus $115 million per quarter. And I'm going to go through the same calculation. So cash, of course, $683 million. Receivable, this is what I don't like, $704 million of receivables. So these loans that have to return to Upstart, right? Liability is 72. So the theoretical margin of safety cash, if you assume that all of the $704 million are going to be repaid, that would be 1.4 billion, which would give you more than 3 years of losing money. They could lose money for 3 more years and not go bankrupt. And then if you assume that none of these receivables are going to come in, you would have only 1.25 years, and so that would be. That would be bad. That would be only 5 quarters before bankruptcy. So that would be bad. And so the truth is probably somewhere in the middle. Right? The truth is probably some of those receivables are not going to come back, but saying that none of them are going to come back is a little too extreme. The proof is probably somewhere in the middle. So this is a stock that I think is going to be very, very Fed dependent. If the Fed pivot happens very, very quickly, which I believe it will, then Upstart would be fine. But let's say Jay Powell keeps doing the nonsense that he's doing, because math dictates that it's not possible to keep rates this high. If he keeps doing that, then Upstart could be in trouble. And you're kind of making a bet on the Fed. I just wanted to show you on the 10Q, the latest 10Q. This is very, very clear. This is not just me saying they're receivable. This is very clear. Loans at fair value, right? September 30th of 2020, they had 700 million. They've almost not quite, but almost tripled the loans on their balance sheet. And there was clearly a CEO mistake here. Why did they decide? Why did you keep issuing so many loans if you were going to keep them on the balance sheet? You have to securitize them. You have to resell them. Just that makes sense. So I don't know why there was this shift in the CEO. Maybe the CEO has too high of a confidence in the business, but that definitely increases the risk, because people who bought Upstart, right, did not sign up to be holding the bags of people who stop paying for their car loans. And Upstart does a lot of car loans. And I'm only concerned, I say this, because the car market is crashing right now. The car market is absolutely crashing. If you follow dealer videos, a bunch of that on YouTube, you'll see that car prices are really, really dropping. Plus, a lot of people may have overpaid for cars. So Upstart, I would say, I'll conclude by saying, will they go bankrupt? I don't know. More digging is required, to me. That's what I will say about Upstart. Either way, no investment advice. Zoom. Let's talk about Zoom. So Zoom's a joke, right? I mean, Zoom clearly has no bankruptcy risk. Zoom at this point is a value stock. They are absolutely a value stock. No investment advice, right? When I say no bankruptcy risk, no investment advice, but you get what I mean. It's a value stock. It's a slow growth, right? It's not growing very fast. Cash machine. It's slow to me, but it grows much faster than the S&P 500. So to someone else, this may be a really, really good growth stock. About 25% of their balance sheet is in cash. So bunch of cash, and they have $350 million a quarter. And that's likely going to grow because they just announced recently they're raising prices across the board by 7%. So Zoom is a cash machine that's trading like a value stock right now. And the fact that it lost 90% of its value it's kind of crazy, because it is a cash machine. So in my humble opinion, there's no any near-term risk of bankruptcy for Zoom, and I don't believe that Microsoft is a major threat to Zoom. They'll take a little bit of business from customers who don't want the high-end product, but that's always been, you've always had Starbucks and Dunkin' Donut. You have two types of customers, two different people. So anyways, let me move on. Peloton. Let's talk about Peloton. So Peloton, right, there was a lot of losses, lots of big scare throughout 2022. A lot of people dropped the stock. They overexpanded their manufacturing facilities. They planned the plant. They tried to grow like crazy because they didn't foresee monetary policy the way it turned out, like most firms, I would say. But that has changed. They have a new CEO who's an operator. That new CEO just made the firm become free cash flow positive. So now it's $109 million free cash flow last quarter. The losses are behind. They have a little bit of debt at $1.6 billion, but to me that debt is manageable. First of all, because they have $1 billion of property, plant, and equipment. Right, I mean that's a capital-intensive business to make these bikes, but still, and ship them, and stores, trucks to install them, etc. But they, what I love is they have close to no goodwill. They didn't fall into that mistake of making acquisitions and then, acquiring this fake asset that is goodwill. I'm gonna get criticized for that, but I don't like goodwill. I really don't. To me, it's a fake asset. So they have no goodwill. So they have tangible assets. Long-term debt is manageable. I didn't look when it rolls over, but it's gonna be okay because they'll be able to refinance it even higher. They can handle it, and the business has $871 million in cash. So to me, Peloton has been reset, and now it's a question of asking, do you think there's gonna be a PE readjustment for this stock? Not a PE, but a price to gross profit. Do you think the market is going to reassess this stock and let it go up? Yeah, I mean, no investment advice, but I kind of think so. It's gone too far down for so many of these innovative stocks. So Peloton has figured out something for a customer. Anyways, And the last one is Opendoor. So I made a whole video on Opendoor and whether Opendoor will go bankrupt. I'll put it in the description. But in a nutshell, I do believe that Opendoor will become free cash flow positive sometimes mid-2023. And therefore, they have enough money because in the worst case scenario, both their cash and the committed financing that they have is $2 billion. So I think they will have enough by mid-2023. And in the best case scenario, which just like I said earlier, it's probably a mix of both, just like for Upstart. In the best case scenario, they have a facility that will allow them to go up to $5 billion in negative cash flow. So I think Opendoor will be fine, but that is the topic of a video that I made a few weeks ago and that I can link in the description. So hopefully that reassures some of you. Hopefully that helps you make better decisions. Remember, none of this is investment advice. Please let me know if you'd like me to do any deep dive on any of these companies, or if you'd like me to do more companies. This was just entertainment, no investment advice. I appreciate any subscribe and any like that I can get. Thank you very much and have a wonderful day.